Hello and welcome to Startup Street. I'm Ritu Singh and with me are Arundhati Ramanan and Shruti Mishra in the Mumbai studio. Here are the top headlines that we're tracking for you today. BharatPe co-founder Ashneer Grover and his wife Madhuri Jain Grover were stopped at the Delhi airport last night on the basis of a lookout circular against them. Both were scheduled to travel to New York. Grover said that the summon from the Economic Offences Wing was delivered to him this morning.
Finnish wearable startup Aura sues Indian rival Ultrahuman at a court in US. Reports say the startup accuses the Indian company of violating patents and copyrights in developing its fitness ring, demands all profits realized by Ultrahuman as a result of infringements.
Masayoshi Son-led Japanese tech giant SoftBank is likely to have sold 2.51% equity in e-commerce logistics company Delivery in a bulk deal worth 747 crore rupees. This comes within a month after SoftBank sold a partial stake in Zomato for around 1,000 crore rupees.
The US government wrapped up evidentiary phase of its antitrust case against Google in a historic trial. The Justice Department sought to prove the tech company is monopolistic and that it uses tactics to dominate online search.
Thrasio, which acquires third-party sellers on Amazon, is preparing to file for bankruptcy as it grapples with the post-pandemic slump in online spending. This, according to a Wall Street Journal report.
China's Alibaba Group has decided to scrap plans to spin off and list its cloud unit. That's due to uncertainties arising from US export controls on chips used in artificial intelligence. Plans to list its Fresh Hippo groceries business have also been put on hold.
Well, India is the largest SME market in the world and contributes nearly $1 trillion to the economy. It contributes 36% of India's total manufacturing output, and going ahead, the sector is expected to contribute more than $2 trillion to the economy, create 50 million additional jobs come 2024, and yet it continues to be plagued by challenges when it comes to financing. To shed light on the current state of financing for SMEs and the initiatives undertaken to address industry needs, we have with us Harshvardhan Lunia, the founder and CEO of SME Lending Cart. As our guest for this segment, Harshvardhan, thanks very much for your time here. 65 million MSMEs, but just 14%, I believe, have access to formal credit. The credit gap is huge, $500 billion plus. What are you at Lending Cart doing to bridge this?
Hi, Ritu. First of all, thanks for inviting me here. I think the group or the bridge is pretty large overall. Credit gap is pretty large, Ritu. I think what's happening, Ritu, is in India, also in MSMEs, the micro and small businesses are still getting funding. The medium and small businesses are still getting the funding, but the micro businesses, right, and very, very small businesses are not getting the funding. It is because of maybe due to information asymmetry, or they don't know how to apply to the larger institutions. The application process is cumbersome, right? The data requirements are too large for them overall. They are fully not aware of what kind of accounts, finance, and everything to keep. So I think we will have to figure out alternate ways of assessing their creditworthiness and then go ahead and provide them money, Ritu. I think as a fintech, we are trying to do that, build the journey for the customer in a digital form and fashion, where we go out, reach to them, and alternate credit models are helping us to do that as well.
Well, Harsh, typically, this is the festive season that's ongoing, and this is when SMEs tend to see higher business activity. So tell us how the season was and how it compared to last year. What kind of credit demand did you see from SMEs this time around?
I think this time around, we've had a fair share of credit demand in SME space. I think compared to last year, all of us have realized that the Diwali season overall was celebrated with much more fanfare, much more overall excitement and everything. So I think in our case, what happens is it's not just the festival season, it is before the festival season, right? For us, like obviously the business starts picking up from July, August, September, in the onset of November, Diwali. And this time we've done pretty good numbers. So last year we had disbursed close to 4,000 crore in the entire year. This year we're looking at something 6,000 crore plus. So obviously the demand, the requirement for this space has gone up, and we are seeing similarly that come up. Furthermore, we are seeing a lot more demand from tier 2 and below cities, Ritu, this time. This clearly indicates that the requirements or the needs of people for business is growing, and I think the business is also performing well for them. And that is what is seen across regions, Ritu.
Well, the Bharat opportunity is what we're always talking about here. But Harsh, lending card has dispersed, you said about 6,000 crores of loans last year, this year compared to about 4,000 the year before. In total, I think you've done about $1.8 billion to SMEs so far. What's the coming year looking like, and what are the targets as far as disbursal is concerned for this and the next fiscal?
So I think this year, Ritu, last year we did close to 4,000 crore. This year we are targeting close to 6,000 odd crore plus, Ritu. I think we've been growing more than 40-50% year on year. So next year we are looking at something around 9,000 crore, Ritu, for us. But again, Ritu, in lending business, it's not a race to a particular loan disbursals and everything. I think in lending business, we have to be very prudent depending on the economy, status of economy, depending on how our borrowers are doing, how the creditworthiness are doing and everything that we decide. As of now, it looks like we are in a reasonably good state. The economy seems to be in reasonably good state. Though we have seen certain lapses happening in consumer credit and we are getting feelers around that, Ritu. But right now, it seems that MSME, which is the backbone of India overall and which almost in I think next 3 years will constitute 50% of our almost GDP and numbers and growth and everything. It seems to be in a pretty good state. So next year, if everything continues fine, Ritu, we should be looking at 9,000 odd crores for ourselves.
Well, Harsh, I'm so glad you brought that up. Prudence is something that the Reserve Bank of India has also been talking about. You gave us a hint about, what you think of the consumer lending bit. But given that RBI norms have just come out, give us a sense of what happens to fintechs like yourself, NBFC fintechs and NBFCs, these new rules stipulating higher risk weight for consumer loans. What will it mean in terms of your borrowing from other lenders? And what will it mean in terms of lending rates for borrowers? And if any, are you concerned about the NPAs?
Yeah, I think fair, Ritu. I think what we've been seeing and we've been hearing across last 6-12 months is urban consumer credit, which is almost less than 1 lakh. The output or outcomes over there are getting difficult, right? I think we've seen certain pain in certain segments, which is the less than 1 lakh urban consumer credit, where a lot of people have been given multiple loans and stuff like that. Ritu, for us, overall, what's happening? We are an MSME lender. We don't get classified under consumer loan. Obviously, there is the circular also mentions that RBI lending or NBFC lending from banks will go up, right? So what's happening, Ritu, is that prior to 2019, right? They were, prior to 2019, RBI had sanctioned that on the consumer loans, the risk weight was 125%. Post 19, they had brought it to 100%. Yeah. Now, reinstated that, right? I think it's prudence on part of RBI. I think it's a welcome move from RBI overall, seeing that if a lot of people are facing certain pains in certain areas, right, overall, and if there is stress building up in this segment, for some time, I'm sure they would want to do this. For us, Ritu, two things are there. One, almost 80% of our portfolio is priority sector lending. So due to that, we mostly don't get affected by these norms. Also, we are a micro and small business lender. So that also needs to be seen up that in that sense. Furthermore, Ritu, our risk weight was already 100%. So RBI has also suggested that where you had risk weight which was lower than 100% overall, and then like it was 20% in case of AA or 50% in case of A category, then you add up 25%. Wherever you are already at 100%, you don't need to increase the risk weight because we are already being prudent in our case, Ritu. So I think these are welcome norms, Ritu. I think ecosystem has to learn to build and grow with this only. I think RBI has been proactive in monitoring a lot of these things. And I think, again, they are doing good stuff to ensure that the ecosystem doesn't go through any pains further.
Harsh, quickly before we let you go, we have 10 seconds. There have been talks about your IPO for a while. Are you any closer to it now?
Yeah, Ritu, I think in some of the other conversation, maybe I would have mentioned, I think IPO is the next is obviously the thing for our final thing for us as well, in terms of we are trustees of finally the money that we take from our investors and we have to give them exits. I think, but we will plan it in due course, Ritu. I think in terms of size and scale, we will end this year at an AUM of close to 8,000 crore, where we are much in large in size and scale than NBFCs that have gone for IPO in last 12 to 18 months. So at that size and scale, at the revenues that we have and profitability touchwood that we have overall, we are doing pretty good. But I think we should look at it in terms of next 18-24 months, how the ecosystem behaves and everything, and then we'll plan for it.
All right. Harsh, thank you so much for sharing your thoughts on that front. Pleasure speaking with you. Thank you.
Same here, Ritu. Thanks a lot for inviting me here.
Well, recognizing the role of SMEs, CNBC-TV18 and HSBC have come together to bring India's biggest SME awards platform to celebrate this sector and its contribution and recognize and honor the builders of India's economy. Nominations for these SME awards are going to open soon, so keep a lookout.
Moving on, Y Combinator-backed Insurtech startup Bimaplan got $3.5 million in a pre-Series A funding round. The round was led by Orios Venture Partners, and existing investors like Fireside Ventures and 2AM VC also participated in the round. Now, the latest funding round takes the total investment secured by Bimaplan to $6 million. Now, the startup will use the funds towards enhancing its technology platform and launch new products. Joining us now to discuss this further is Vikul Goyal, the founder and CEO of Bimaplan. Vikul, thank you so much for joining us on the show today. Bimaplan essentially helps insurance companies craft affordable products and reach low and middle income customer segments. So talk to us about how you're using tech to do this and what do you have on offer?
First of all, thanks, Arundhati, for inviting me. See, if you look at the insurance sector, insurance companies have largely focused on affluent segment of customers. And the distribution channels largely used for that have been offline in nature, right? Using agent networks and broking channels. Now, there are certain limitations posed by offline networks in terms of the policy size that you can sell, in a profitable manner, right? And which is why a lot of the lower middle income populations do not either have awareness of the products or access to these kind of products, right?
Right.
So what we are doing is we're working with insurance companies to create a technology platform, or we've created a technology platform which works with insurance companies to be able to profitably distribute these products to these end consumers, which otherwise would not have access to these kind of products. So what we do is we analyze a lot of data, we help them craft those or underwrite those plans, and we help them distribute those plans with the help of channel partners,
right,
who are already connected to these users in tier 2 towns and beyond.
Sure.
So this is, we are a full stack platform. We help the entire user journey on our platform for these insurance companies,
absolutely,
and distributors to create higher insurance penetration
right,
and adoption of these plans into these segments which traditionally haven't had insurance penetration.
Correct. So you're helping tier 2 and beyond cities have access to these products that otherwise they didn't have. You've raised $3.5 million about last week. How do you plan to use these funds? If you could quickly tell us also any new offerings in the pipeline?
Yes, absolutely. See, the whole idea is to reach as many people that need insurance but do not have access. So a large part of the funds will be utilized to create new channels and to create a deeper distribution network to reach the end customers. A part of the funding will also go to strengthen our own capabilities in terms of hiring our team, scaling our technology platform, and building more relevant products and working with sort of more insurers to build those products, which will ultimately help more people.
Sure. And you're also essentially creating insurance products for Bharat, right? So what's working? Which products are you seeing the most demand for? And how many people have you catered to? And how do you plan to grow this?
Absolutely. See, there is no one-size-fits-all in this segment. It's a very non-homogenized audience. What works for a farmer is different from what works from a delivery personnel in an urban location, right? So what we do is we kind of understand the risk in the life of that particular segment of the population, and we work with insurers to customize products to cover for those kind of risks. Just to give you an example, right, we are working with a set of farmers and farmer producer organizations in Karnataka, Tamil Nadu, and Telangana, where we are creating a product where there is a risk protection in case of a vector-borne disease, for example, dengue or malaria or any mosquito bite diseases, or a snake bite while working in the farm, and so on and so forth, right? Which is more relevant to to that farmer. But we're also working with e-commerce delivery companies to provide an accident insurance for their delivery riders, for example, right? So products for every segment are different. I think one thing that is common across when we design these products, or the approach that we take, is that it has to be affordable. It has to be a non-starter when a person starts to think, should I buy this? Can I afford this? Right? Because this is a new concept, right? Insurance is not something that people have used before, especially in that segment. So you need to kind of give them micro products for them to kind of take the benefit of those products, and then learn more about it. And what happens is, once someone gets a claim, it communicates within that community that this insurance has helped that person. So I think the idea is to give these insurances, but also to kind of create that awareness and confidence that these are products that work and will help in case of unfortunate incidences.
Right, absolutely. So no one-size-fit-all model over there. But what about revenues? What are you currently clocking, and what are the targets you're seeing for this year end?
Absolutely. So I don't think we are still an early stage company. The North Star for us is the number of people that we serve. We've served over 1 million customers over the last 2 years. On a monthly basis, we serve over 150,000 customers per month. These are new customers that we onboard through our platform. So that's sort of the North Star metric for us. In terms of revenues, while I can't disclose the actual numbers, but we are generating revenues, and we are while we are loss making, we have reduced our burn by 50% over the last 1 quarter, and we continue to do so. Build the startup in a profitable, sustainable manner.
Right. So you've reduced your burn by 50%. All right, Vikul, we're completely out of time, but thank you so much for joining us on the show today. I also know you're really unwell. Hope you get well soon as well.
Thank you so much. I appreciate it.
On that note, it is time for us to head into a short break. But coming up next, we put the spotlight on 10 Club Homes and its expansion plan. We also take stock of Humane AI's AI PIN. That and more on the other side. Stay tuned.
Welcome back to Startup Street. Fireside Ventures-backed 10 Club pivots into the next phase of growth with the launch of 10 Club Homes, a consolidation of all acquired businesses into a robust single brand. With this strategic consolidation, 10 Club Homes now plans to disrupt the $30 billion home and kitchen space. And to elaborate on the road ahead, joining me now is its founder, Bhavna Suresh. Bhavna, welcome to Startup Street. Elaborate on the need to now consolidate businesses into a single brand, 10 Club Homes. What is the impact you now hope to create? And also take us through your key offerings.
Sure. Thanks for having me. We've been in the journey only 2 years, so it's relatively new still. But even right at the beginning, the goal was always to create some sort of a conveyor belt where we had bought businesses that were generally operating only on marketplaces. So, they would only operate on Amazon, and that's how we kind of bought them.
Yeah.
We put them all together right at the beginning, and we kind of created a conveyor belt of sorts. To give you an idea, we had about 8,000 SKUs on day one of operations, right? I think the intention there was, it was always a $30 billion market. It was always something that was very, very large and just waiting to be disrupted because there are such few brands in this space. It's still predominantly an informal sector play. I think what we did not know 2 years ago was whether we would make one brand or multiple brands from the conveyor belt. I think as we started consolidating and picking our winners, we realized we wanted to build one solid brand for India, and that itself is a decade-long journey.
Sure.
And that's kind of step down to do now.
Okay, like you mentioned, you now plan to disrupt the $30 billion home and kitchen space. It is a competitive segment. Bhavna, what makes your offerings unique and how competitively are you priced?
So I think we were very, very clear that we were always going to be for the value segment of India. And that is why the first step for us in this journey was to go into something as competitive as Amazon and Flipkart. And I think the idea is if you can operate there and you can bring value to consumers there, we believe that's the right large market to play in. So that's what we are. Most of our goods are priced between 250 and 700 rupees. And that's the category that we're playing in, and that's the opportunity, we believe.
All right, Bhavna, can you name some of the companies that you're in talks with for partnerships?
We've just started. I think the way we want to approach this market is we want to go city-wise. So we've just launched a pilot with 5 stores with WakeFit a couple of weeks ago, and we're in conversation with a bunch of new partners where the services could potentially be complementary.
All right. You also plan to grow from the current 100 crore rupee to 1,000 crore rupee company. By when do you hope to achieve that target? And what makes you bullish, Bhavna? Where do you see the next leg of growth coming from?
So let me answer the second question first. I think, like I said, it's a huge, huge, huge opportunity that still is completely unbranded. So I think that itself is a massive opportunity. And I think as India's consumption, as an economy, as we go from 3.5 trillion and we grow to that 10 trillion mark, I think the opportunity is immense, right? Consumption is going to increase. And with that, so does discretionary buying on anything to do with home. So I think that's the big opportunity all of us are betting on. Now, the 100 to 1,000 crore, I think the simple answer for me is I'm building for the long, long haul. So I'm not in a deep hurry. I would prefer to kind of do this foundationally right. So I'm building over the next decade, and I think 1,000's a mid-mark number for it.
Okay. Now, before I let you go, one final question. If you could talk to us about your global plans. Are you eyeing global shores?
Not yet. So I think we were very, very clear that as a company, we do one thing at a time. So last year was all about conquering marketplaces. This year is about kind of consolidating into a brand. We're very clear we're building for the modern Indian. So a fair number of us are here first. And I think once we feel like we're comfortable with India is when we take it to the rest of the world.
All right. And we wish you the very best. Many thanks, Bhavna, for joining us on Startup Street today. Thank you so much.
Thank you.
Friday, and it's time to take a look at the funding picture for the Indian startups. According to data from Venture Intelligence, in the week gone by, startups saw 8 deals valued at $50 million. Some of the notable deals include online bakery brand Bakingo, attracted $16 million from Faring Capital. Building design startup Snaptrude raised $14 million from Fundamental and Axel India. Insurtech firm CoverSelf received $8.2 million from BNext and 314 Capital. That's not all. It also bagged $6 million from Fireside Ventures. The startup is a health tech firm that focuses on women's fertility. General Autonomy raised $3 million from India Quotient, Elevation Capital, and others. This startup is a robotics company that aims to pioneer industrial robotics infused with AI. Indian startups collectively have witnessed 510 deals in 2023 till date. These deals are worth over $6.39 billion.
Well, with that, it's a wrap on this edition of Startup Street. But before we go, it is the weekend that we're all really waiting for. Here's wishing our men in blue the very best of luck for the finals this Sunday. Stay with CNBC-TV18. The news and updates will continue.